How are you now? James Whelan here, VFS Group, and I hope that you're having a great whatever, wherever you are. Now a few things just coming up on my note. First off, watch out. Bill Kramer says as the market starts to cool down, it's okay to get bullish. Beware, beware, beware. Now we are a little bit underweight, especially tech at the moment. So it sort of feels awkward, feels uncomfortable, feels a little bit naked. But it's just something that you should be comfortable with. I think that the more that I see things, the more that I'm just sort of not trusting exactly where the market's going. I'll probably be wrong, but that's why you don't take the entire thing off and why you definitely don't go short. You've always got to make sure that you've got some allocation. It's just a matter of just tweaking that up and down. I think the way that things are looking right now, and this is sort of where it hit me. Look at the jobs numbers that came on Friday. That was insane that the market rallied off the back of those jobs numbers, saying, oh, the economy's good, no soft landing or a soft landing or no hard landing, that's great. Everything's going to be up. It's just like, hang on a minute, when did good news become good news again all of a sudden? I thought that we still worried about the Fed raising rates, but the debt ceiling thing seems to have eased a lot of concerns. Okay, yes, it has. The debt ceiling has been resolved. It's basically a blank check or an unlimited ceiling until whenever. That's a long time. Whenever is a long time. And it's late in the day. Just give me a chance, okay? But if in effect it is, people, I still think are discounting exactly how big the big question mark is over liquidity. If there are enough question marks over this with the T-bills, $1 trillion worth of T-bills, where money is going to flow from to go and do that, phenomenal amount of stuff that's going on. The question marks over that particular event could fill a warehouse. Now, you know what? I didn't really go too hard into it. I really, for the last few weeks, just focusing on getting that debt ceiling through, not having too much focus on it. Remedied that. I still think that there's a lot of issues that we've got ahead and risks that are being probably undervalued by the market as a whole, especially the market, which would probably include a lot of the retail people with the buying that they've been doing. Now, there was another thing as well, that the Fed should be seen to be raising rates. However, they're not. So, okay, they're not being seen to be raising rates, but what we've got is the fact that we've got the credit crunch, or a bit of a credit squeeze at the moment, also with restrictions in banking, so own banking hesitancy to go too hard into the lending market or to overlend, basically just to slow down a little bit of the lending after what happened a few months ago. That's that sort of hesitance that they've got. Potentially what banks see is different to what we see as well. Maybe there's different stuff that's going on there too. We already know that is the fact with their feelings on what happens with the market. However, people are seeing that credit restriction is enough to sort of be a proxy for the Fed raising another 25. That's not me. That's actually the Goldman Sachs strategy desk or the Goldman Sachs rates team and what they think that's ahead. Interesting. I actually sort of agree with that as well. I think that's the way the market sees it. So that's okay. So, and also keep in mind that also these T-bills and this huge debt ceiling explosion again, going to the next level, is quite inflationary, according to the people who know. That's interesting. So quite inflationary means potentially rates higher for longer, not necessarily up, but higher for longer. Bond yields won't come back down that quick, so bonds aren't going to rally as fast as potentially I originally thought that they were going to. I'm still a big fan of the 60-40 portfolio. I would now be over-allocated into bonds if I could be, but just keeping in mind that we could have a bit of inflationary pressure ahead of us with whatever this debt ceiling situation brings us, puts on the table. Again, I said question marks over that. Beware the beware the amount of calls that are being bought in the market at the moment. That the call volume is going back to genuine 2021 levels. That's some pretty hefty times. Remember what we saw in 2020, 2021, the Robin Hood crowd at home buying calls and the gamma squeeze that happened after that. You buy calls, the market makers have got to go into the market based on their exposure that they have to those calls that they've sold. They have to go in and actually buy the underlying as a hedge. As the underlying goes up, they've got to buy more of the underlying, more exuberance goes into the call market. You know what happens next, it's an explosion. We're in the midst of that potentially right now. That's seen tech rally also with the AI revolution that apparently has just come out of everywhere and every man and his dog. The market is being held up by 7 stocks. I'll say that again. The US market is being held up by 7 stocks. I believe that 7 stocks make up 50% of the S&P 500. That cannot hold. That is just too much. It will have to revert to the mean at some stage. The inflows that have gone into tech have been phenomenal. I don't know if it's retail or not. I don't have that chart in front of me. Something to look into that. I still suggest that taking some risk off the table is prudent in these particular times. Everything that you see. I like this Lawrence McDonald We don't have this is NVDA, talking about NVIDIA. We don't have a fab, which is a semiconductor fab plant, totally dependent on geopolitical tranquility in the South China Sea. But at 37 times sales, have no fear, are good at meta chips, crypto chips, AI chips. NVIDIA, I do honestly believe that they're chips, and I do believe in the AI thing. However, NVIDIA have a really good knack of just being in the right place at the right time with the right chips all of a sudden out of nowhere. Maybe they're just lucky. Maybe they're just very good at these particular things. But it's always just seen every single time there's a thing, there they are saying we make the best thing in that particular area. Maybe they do. Anyway, they probably do. China has solved, get involved. We're seeing policymakers leaning towards stimulus, which is great for China, great for us in there as well. However, you wouldn't know that reading the news about China in there. Locally, our market, RBA, coin flip. Gareth Aird is the one that I listened to from the CBA. He's 70% no hike, but sees that potentially it was a dead meeting. Now it's a live meeting again. Pay attention to that, what's going on. And amazingly, just of an interesting point of view, the Russell 2000, which some people have mentioned sort of could be sitting on sort of a support line, or come off a support line that used to be an old resistance line, so that those lines do get stronger. That it's a buy, some people suggesting, but okay, just keep in mind that almost 38% of the companies that are in that particular index, the Russell 2000, are unprofitable. That compares to, let's go pre-COVID levels. Let's just say 2020, so just before COVID hit, it was at the low 30s. So from the low 30s to 38%, not really huge signs of a really strong economy, and I think that this is just more of those two economy situations going on. Anyway, that's my 7 minutes. I'm James Millen, VFS. Have a good one. Bye.